investors are fixed on stocks of UBA, GTCo and Access Holdings as analysts say they expect the positive momentum to continue on the back of improved sentiment. Praise Ihansekhien, team lead at Meristem Research, joins us now for more market updates. Praise, thank you so much for joining us on the show today. And that was quite a tongue twister there with your surname, but let's talk about the highlight of trading at the equities market this week. At intraday, it was trading flat, but for you, the highlights of the week, the highs and lows, and what's driving the current market sentiment.
Yeah, thank you very much for having me, Aki. It's an interesting week. It's been an interesting week so far. Coming into the week, we expected the mood to be positive in the market. Comes from the fact that we had a mostly bearish market mood in September. And then coming into October, we've seen that marginal upward trend in the market. But for this week, we broadly expected the market to be positive. And then we've seen some actions on stocks like grass cement, and some of this action has also helped to improve the market sentiment for this week. I mean, we mostly had three positive trading days, while the market closed negative on just Tuesday. And then, the jury's still out on, market should be closing right about now. Then we should have, the final results for this week. But as you said, we're expecting a flat trading week, basically marginal performance in the market.
And another area of concern is also looking at the area around possibility of profit taking and whether or not we might likely also see significant sell-offs as well. Now, as we've inched into the middle of the month, how do you see things panning out to the rest of the year and the stocks that are within your radar?
For the rest of the year, basically, for the end of October and into the remaining 2 months of the last quarter, we still expect that positive sentiment to be, to be across markets. Of course, there are going to be pockets of profit-taking activities, maybe even sell-offs here and there. But the main thing that is going to happen is that the overriding sentiment is most likely to be positive, given the fact that the fixed income yields are currently not significantly encouraging, and yields are rising in the fixed income space, which means the prices are low currently, and then based on that, we don't see investors tilting towards the fixed income space. That's one. And on the other side, there's also possibilities that on the macro side, investors are priced in most of the macro indicators, unless we see a very significant macro indicator that comes and changes the current expectation in the markets. Right now, the market is expected to remain positive, but with pockets and instances of profit taking here and there. On the other hand, also as investors are really pricing the things that they want to look at. We're also expecting 9M results to come out very soon, and the likelihood with 9M results is that most companies are not, they don't pay dividends from 9M results, so we don't expect the reaction to be as significant as you would have with a full year result or an H1 result. So for 9M, we expect the market reaction to be mostly muted. That's one corporate action that would have driven performance in the market. But we expect markets reaction to 9M results to be mostly muted in this Q4, and then overall sentiment is going to remain positive, but there's going to be profit taking on some tickers.
No doubt, we have our eyes fixed on the 9-month earnings figures. As we've also seen, it was quite impressive numbers we saw within the first half of the year. However, with the impact of the new reforms as well, which also took effect much more from the month of May towards June, July. Now, that has also raised a little bit of concerns. But for you now, let's also take a look at some of the direction we are seeing the CBN take now. Yes, we've had the pronouncement from the CBN saying they're going to revert to evidence-based monetary policy. Not so much can be held on to. But this latest information about the ban, the lifting of the ban on the 43 imported items now. For you, how's the market reacting to this?
This is a really positive step in the right direction for the CBN, and this is one of the things that we've been clamoring for to increase that stability in the FX rate. One of the major things has been removing the ban on the 43 imported items, and that coming into the market is quite a positive move from the CBN. Of course, to allow this to permeate the FX market and allow the effect to be really felt, there still needs to be significant liquidity improvements in the FX market. So while the investors or importers that had to, go to the parallel market to get their FX rates for these items. Now there will be demand for these items on the official rate. So we expect that this would increase demand on the official window. However, the liquidity is still very important because this is what will determine how the rate is going to appreciate or depreciate. In the meantime, even expecting a depreciation at the official window because the demand is going to be higher, and then there's a possibility that official and parallel market rates begin to converge to a midpoint at some point. But right now, while the move to remove the ban is a very important move, we're still watching out for how liquidity moves in this market, and of course, market participants are going to react to this, especially for companies that are importing things like maize, importing things that palm oil that are predominantly on that list. We expect that this will impact their financial performance for Q2, and then definitely impact investors' response to this.
For some analysts, there's no magic wand that we can wave to ensure that we have this liquidity we are looking out for, and the reintroduction of this list also means that we are adding extra pressure. But for you now, let's talk about the impact, especially with specific interest to fast-moving consumer goods as well, and the sectoral performance, the sort of dynamics we should expect in the coming days.
One of the things that has been very significant for FMCG companies, and very significant for FMCG companies, is the FX component. A lot of them are exposed to importation and having to import their raw materials that they use for production. And then while some of them are able to get some of these raw materials on the official window, a lot of them were banned from getting these raw materials the FX, from the official window prior to this announcement. So with this, being able to get the FX at the official window is definitely going to reduce their cost of importation, and then have significant impact on their cost of production and even operating costs to an extent. This would be a positive one for the consumer goods and companies. But this positive result is most likely not going to be seen in the meantime, because remember that even on the parallel markets, FX rates have significantly changed from what they were this time last year. So we're still going to see some significant FX losses for this year until we get to a point where liquidity starts to stabilize, and then we start to see increased demand and supply of FX on the official window. Then we would see that reduction in FX losses, and then foreign exchange losses, and even revaluation losses for their liabilities. So for FMCG companies, at least for this year, the impact is not likely to be significant, at least for this year, because compared to this time last year, the FX rates were not this high, even on the parallel market. So the impact is not likely to be significant for this year. But going into 2024 and beyond, there's significant expectation for, if the reforms continue to come out like this and liquidity continues to improve, there's significant expectation for improvements in production costs for FMCG companies, increase in their profitability, and of course, we expect market participants to also react to that information.
And for the banking sector, oil and gas, and the quiet insurance sector as well?
Yeah, for the banking sector, and we'll definitely say they were one of the gainers during this last FX evaluation that happened, to the extent that the CBN had to release circulars that the companies were not allowed to use the FX revaluation gains for dividend payments. But we could see that FX revaluation significantly improved the banking performance, and then this is expected in 9M also. 9M, and even going into the end of the year, we still expect that from their results, we're still going to see that significant improvement and revaluation gains. Of course, not going to be as significant as it was in the first half of the year, but still significant, premised on the fact that FX rates are significantly moved. And of course, for the insurance sector, the expectation is quite modest for the insurance sector, because even in the first half of the year, not all the insurance sector were profitable enough to take advantage of the FX gains, and not all of them were able to record profitability. So the expectation for the insurance sector is quite modest for this second half of the year. For the energy sector, the energy sector has seen a lot of reforms this period. Even with the upstream sector, we are seeing oil prices increase with Saudi Arabia's production cuts, Russia's production cuts, even with the recent possible ripple effect of the Israel and Hamas war. So there's that impact that's likely going to have on the oil prices for all upstream sectors, and of course we expect it to be positive. But for the downstream players, the fact that there's been significant increase even in their cost of having to source the the oil from the oil marketers, the downstream players. So there was significant low and reduction in demand at some point, even though demand for petroleum products have increased now, but at some point, immediately the first subsidy removal occurred, there was some reduction in demand for those petroleum products. So we expect that to, in a way, affect their financials for at least 9M, but we see a potential recovery by the end of the year, given that the demand has pretty much increased by this period of the year. So the sentiment for the energy sector is also quite positive in terms of their fundamental performance.
Well, we'll definitely keep tabs on all of the reforms as they unfold in the coming days. Praise, thank you so much for your time on the show today. That was Praise Ihansekhien, team lead at Meristem Research.